Welcome to the Financial Edge. I'm Erin Kennedy. 5 investing mistakes you might be making right now and how to turn things around. Today's guest is Chris Hoffman. Chris is the founder of Hoffman Financial Group, an Atlanta area firm that focuses on preparing people for a successful and happy retirement. Chris is also the popular radio show host of Money Unleashed, and Hoffman Financial Group is the official partner of the Georgia Bulldogs. Chris, good to see you.
Financial risks and financial mistakes. Don't like that language, so I'm not sure where this is headed, but
this is by
let's
popular
tackle it.
demand.
Okay, all right, you're scaring me.
Making these. Well, don't worry, we're going to help you set people on the right track. But let's talk about mistake number 1.
Okay.
This is getting out when the going gets tough. I want to show people what happens when you miss the best days in the market. We're going to show a graphic that shows a $10,000 investment over a 15-year period, 2006 through 2021. If you would just stayed invested, that $10,000 turned into 45. If you miss the 10 best days, 20,000, and so and so and so on. You can't time this.
No, you can't. It's time in the market. It's not timing the market. Everybody knows it. They've heard it. But it's tempting, especially the individual investor we find does this more often. And I'm not a big fan of the big box firms. I think they have their flaws. But individual investors, they try to time the market. And any time out of the market, you're risking missing the 10 best days or 20 best days or 30 or 40 best days. It can really damage your portfolio. The other side of it is you never know when to get back in. If you missed the best 10 days, you're thinking, I need for the market to come back, and it may not. We've had an incredible bull market run over the past 12, 14 years. So a lot of people got left on the sidelines, pushed in too late, and they may see their portfolios damaged when the market corrects. So it's time in the market. That doesn't mean you keep every stock at its current level forever. You can rebalance it, but you should stay actively invested in your equities portfolio or in the markets.
Right. Just to remind everyone, those best days are often smushed right up against those bad days. It can rebound like that.
Yeah, I call it whipsawed. I've had clients ask me, do I put stop losses on stocks? And the answer is categorically no, because if you lose 10% on a stock and you sell it after a 10% loss, you're selling low. You're supposed to be selling when it's high, and inevitably, if it loses 10% and you sell it, guess where it's going to go the next day or week or month? Up. So we don't do stop loss orders.
Okay.
We do dollar cost averaging for sure.
And the next mistake is taking on too much or too little risk.
So that's a personalized preference and something that we work closely with families to identify. And oftentimes, the spouses will be different. Yeah. One of them will be, I want to be in the market, in the NASDAQ, in the Mag 7. I want growth, 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 growth. And the other one's like, I don't. I just want to generate a heavy income stream from my investments. So it's very individualized. I think it's a matter of knowing exactly what your risk profile is in your portfolio, not in your head or in your heart, but knowing how will your portfolio behave if the market goes down 10, 20, 30%. How exposed? Are you exposed 100% of it? I have clients that say, no, I want to be exposed 120% of it. If the market goes up 10%, I want to make 12. If the market goes down 10%, I'm okay losing not 10, but let's say 8 of it.
Right.
So they have a higher risk profile and they're willing to wait for a longer period of time for it to come back. It also comes down to how many years of investing do you have. So if you're getting older, you have less years to recover from big market losses. So we typically try to get a little bit more conservative without sacrificing big chunks of growth to lower your standard deviation or lower your measure of financial risk.
Now let's talk about the risk that comes with not rebalancing your portfolio regularly. And we can show people what this looks like. If you don't rebalance, you are probably taking on way more risk than you even know.
Yeah, so this is obviously an extended period of time, 30 years, and over 30 years, obviously we know that historically the stock market does well over a 30-year period of time. If you're not rebalancing and taking some of those gains and reallocating them to lower standard deviation, you're basically pressing in. This is fear of missing out. You're staying in the market. You're happy, if not exuberantly happy, about the performance that you have, but you're stepping out over your skis. You're exposing your portfolio to disappointment during the correction years. So rebalancing your portfolio, I think, is critical. And I would say you can do it a little bit faster than annually. We rebalance our portfolios every 3 to 4 months.
Really?
Yep.
Oh, well, now you're making me feel like a laggard here. All right, mistake number 4, and I know this one is near and dear to your heart, paying too much in taxes.
Yeah, we don't like taxes, and we, especially for retirees, do not like the words income tax. I don't believe anybody who is retired should pay an income tax. It's not income. You've earned that money, and it now pays you as if you're the bank. So we fight against income tax. Capital gains tax is okay. We love tax-free money. We love Roth IRAs. We like cash value life insurance as a tax-free income stream later in life. But you have to avoid and fight against income tax. How do you do that? Well, make sure your pre-tax 401k or pre-tax IRA doesn't balloon to be a disproportionate amount of your total assets. So if you have a balanced account and you've got taxable money, tax-free money, and pre-tax money, you can now choose where to pull from. You've got multiple distribution strategies even before your required minimum distribution ages. So that's powerful. The other thing is people that have $500,000 in pre-tax IRA, it's entirely possible you will never pay tax on that money, even though you never paid taxes on it in the beginning, because of standard deductions and some other tax breaks that are built into our IRS tax system. You may be able to distribute that $500,000 and the growth to you over your lifetime without paying any taxes on it. We need to study it, and it's an individual financial plan that we would put together to see where you stand with that.
And then the last mistake is not seeking professional advice. You should really ask yourself, do I have the time to do this? Do I want to do this? Do I have the skills to do this? And if the answer to any of those 3 questions is no, you should probably ask for help.
Yeah, and if you're watching us right now and you're saying, oh, I know all of that and I can manage all through it, okay, well then you might be that 1 or 2 people that can manage it on your own. But there's a lot to it. It involves not just how much money you have and how you invest it. It involves tax strategies, and it involves you becoming the bank. And what I mean by that is you have a pile of money and everybody wants to borrow it. Loan it out to the appropriate people that will pay you handsomely for it. And when I say loan it out, that may include purchasing stocks, and you're not loaning it, you're an owner, but they are obligated to pay you a dividend. So you can get interest payments by being the bank, you can get dividends by purchasing portions of companies. You're no longer in your 20s, 30s, and 40s. You're no longer have the large mortgage or leasing cars or taking on student debt. Now flip it. Everybody wants to borrow your money for them to fund their lifestyle. They can borrow it as long as they pay us a healthy sum for it in an income distribution plan.
Right. I love it. Chris, thank you.